Welcome back, everyone. Mike here, your legacy wealth coach, joined again today with my partner in crime, Pay. And today we're going to talk about a topic that is near and dear to us, certainly. Anyone who's, interested or doing infinite banking concept, IBC, DIBS, income stacking, certainly. And that topic is the policy loan.
Absolutely. We are a little rusty from coming back from a long trip. So excuse us if we're a little glitchy today, but this is an important topic, and it's great to have this conversation with you about it, and so that we can kind of document what we're thinking or what our thoughts are when it comes to this, and hopefully help our viewers and listeners get some clarity
Unpack this
on
topic. Yeah.
exactly. So this when I first heard about IBC and policy loan, these are kind of the questions that I had personally, right? So essentially, when people first hear the term policy loan, what do you think that they usually are assuming is happening, or what do they assume?
Yeah, so let's take those two words, right? Policy loan, and I'll use air quotes, and this episode should hopefully explain why the air quotes. When you hear of a loan, right, whether it's policy loan, personal loan, business bank loan, you think of, money that you take from, somewhere else, right, that you use for a certain time. If it's a bank loan, you're borrowing their money. You're taking that money, they determine how much you can borrow, what rate that is, and how you got to pay it back, because you certainly got to pay it back on a monthly basis. So that's what people think. When they think of policy loan, they think, oh, it's the same thing. I'm going to borrow from, now my policy, take money out of my policy for that purpose and then pay it back as I can or as I need to. Okay.
So
So
what tends to be the big misunderstanding or confusion
sure.
around this particular topic or concept then?
Well, the misunderstanding is simply that it's just the same thing, right? It's
Mm.
just coming from a different place. And that is, unfortunate because they're missing a lot when we're talking about actually, what a policy loan is versus a bank loan. Mhm.
Yeah. And I think also typically when people think about the word loan, I just wanted to also add this part. They're
It
thinking
scares
about it
people.
like and also the car note or the mortgage loan, they're thinking that it's a fixed term, fixed monthly payment type setup versus this is kind of getting into the details of the policy itself a little bit.
Yeah.
It's different, right?
And I forgot to mention just that loan, that word loan itself will immediately conjure up some negativity for a lot of people, especially if you're very
Mm-hmm.
conservative or you've gone the Dave Ramsey route where all borrowed money is bad, debt is bad, borrowing any type of loan, you got to kill it. Don't touch it. So there's also that. Yeah.
Definitely. So confusion for people out there, I think, you're right that it's just because historically, or there's a lot of baggage when it comes to those terms, like you said. And then,
Yeah.
of course, just maybe not even understanding properly what
Sure.
different types of loans are out there. So that's why, a lot of times, even
Yeah.
that part, when people catch on and say, wow, these are actually simple interest, revolving lines of credit, not a loan. There's a distinction. You want to dive
Yeah.
deep into that a
Okay.
little bit? Yeah.
So let's back up, right? Back to that loan. What happens when you take a loan? Okay, you qualify for a certain amount, okay, that the bank decides, and then you borrow that amount, and they will calculate that interest rate, right? And if it's a car loan that's like 5, 6 years long, they'll spread out that interest over, 60, 72 months. And it's actually going to be a lot more interest than, that 4 or 5% might suggest because it's amortized. Okay. So loans are typically going to be amortized, certainly once they're, past 1 year. And you'll have a fixed, payment of which you're paying back principal plus interest over that time because the bank wants their interest right away. Now, it's different with, like you say, a revolving line of credit. Well, what's that? So it's also money that you get to use, but you're taking it, from, your policy loan. Okay. And here, you're not, it's not functioning the same way.
Mm-hmm.
It's the same thing as if you were, to borrow from your credit card. And nobody says that, that $6,000 credit card balance is a loan. it's literally just a outstanding balance to the day as to how much I still owe on this line of credit that, by the way, as I pay down or pay off, I'm no longer, paying so much interest on a declining balance, right? The loan itself has that fixed interest rate stretched out for the period of the loan, so it ends up being quite a bit more interest.
Yeah, very cool. So when people do take a policy loan, once they get their policy set up and they, get it started, walk us through what is actually happening behind the scenes when that
Right.
loan, right? You call up the policy loan. What
Sure.
is actually happening?
Okay, so to keep it really simple, right? The assumption is when you borrow, from a loan or, through a loan, you're taking money from somewhere, and they, the bank will give it up and give it to you to use for that time until you pay them back with some interest, obviously, right? If I was to say, and that's borrowing, that's like, hey, if I went to my neighbor and said, hey, I need to borrow a cup of sugar, what happens? Well, they'll take out the sugar. That cup of sugar leaves their house, comes to my house to do whatever baking or whatever we need to, and then it doesn't go back to them until I return it with some interest, hopefully, right? That's typically a loan, and that's fair. That's what it is. It works differently with a policy loan, remember. So what happens here is, the terminology even is I'll take a loan from my policy. So the assumption is the money is going to come out of my policy and I'm going to use it and hopefully repay it in time, okay, over time, back to replenish where that money came from, right? My policy. Actually, that's not what happens at all. Remember, when we're being our own banker, we function like the banks do. So literally, there's a word called collateralization or collateral that makes that difference, huge. Now we have an asset here. This is, remember, a policy that we're borrowing from. A life insurance policy has at its backbone the death benefit, and you have a certain amount of cash value or equity in that policy. That cash value as equity is the collateral upon which then the insurance company determines how much you can borrow. And however much cash value you have is how much you can borrow, not out of your policy, from them, the insurance company. So you get a line of credit, essentially a revolving line of credit that functions and just the same way you can use that money and pay it back on a more flexible schedule we can talk about, typically with a lower rate, but all the while having this tremendous asset of the policy, the death benefit, the cash values, uninterrupted, compounding, tax-free. Huge difference.
Yeah. I think words matter when it comes to IBC policy or understand how to understand IBC policy,
Absolutely.
because the distinction between borrowing from your policy or from your own money versus the distinction between borrowing against your money. We even, we've been practicing IBC for so many years. Even we misuse the word because it's just so easy to go back to the old way of referring to. But we always have to remind ourselves to be careful when we are using these words. We are borrowing against, we're not borrowing from our policies, and that's a huge distinction.
Yep.
And I want you to help us then frame it in, like, compare it to something that we're familiar with, like a HELOC.
Okay. Sure. A HELOC is also, a loan, right? Home equity. However, it's not home equity loan. That's a different instrument at the bank. They'll often confuse it and, sell you the loan because that's more expensive. The home equity line of credit, that's the HELOC, line of credit. This is different. This is revolving. This is an instrument that only charges interest on the exact balance that you still have outstanding versus locking it in at that original major, principal amount. So it tends to be much cheaper and revolving in the sense that you can use it and pay it back and use it and pay it back on a revolving basis, like a door where your capital can flow, which is important for velocity banking. With a loan, it's a fixed time period. You got to pay on this certain schedule. And once you pay down so much, you got to keep paying. You can't borrow more from it, right? That's the difference. It's not revolving. It is static on their schedule. Yeah.
The one key thing to add is that no matter how much loan you have outstanding,
yes,
your mortgage or on that home equity line of credit loan, your property, think of this question.
Yes.
Does your property drop in value because you have an outstanding loan?
That's right. That's right. And I forgot to mention, right, this line of credit is home equity line of credit. it's collateralized or backed by your home. Okay, so that is more similar to the policy loans, mechanics as far as how it functions. But like Pay, you mentioned, right? Same thing applies. As you borrow from your HELOC, is it going to affect the value of your asset, or in this case, the home? It does not. Your home is still going to be worth whatever it is. The HELOC is just a separate instrument or pool of cash that the bank will extend to you based off of what? The value of your home. But the value of your home remains intact. Yeah.
Yeah. And the beauty of an IBC policy is that that value is guaranteed to grow versus my property,
Is
depending
not.
on the environment of, my
The
property
mythical 6%
value.
every year, right? Yeah.
Right. There's no guarantee that my property is going to grow and appreciate
That's
every
right.
year. Historically, it does trend up, but there's no guarantee for that, right? Versus policy. So I really wanted to kind of hone in on that one. So let's get to the next question that I have is how does that change the way an investor, right? Because this is our group of people that we tend to talk to and work with. What does that change? How does that change the way an investor thinks about using capital then? When they start IBC policy
Sure.
and using the loan.
I feel, I mean, I can speak for ourselves, for myself, like it was a very liberating feeling, first of all, to understand that, hey, wait a second, I don't have to, do this and give up that, right? It's that asset in that sense where now, okay, I can still get that money either from the bank or from my policy loan, right? Um, so that side is the same for the most part, but I don't give up any of that growth that I have in that asset of the policy and the death benefit cash values growing. So in a sense, I already locked up my capital and I get to use it again. Isn't that cool, right? When
Mm-hmm.
it's collateralized, I'm not taking from the original asset. I get to use the insurance company's money now, and I can earn the same amount or profit potentially as anywhere with the bank loan, but the bank loan doesn't have that asset underlying. Yeah, so it's very freeing,
Right,
and it allows me to make my decisions on a in a better basis of competence and some confidence that my capital secure at least. Now I can make more calculated decisions as opposed to rushed or feeling pinched because I got to make that loan payment. Yeah.
right. So you touch on control, right?
Yes.
Policy loans under your control. We touched on flexibility, right? Compared to, let's say, the
Mm,
traditional banking
that's right.
loan. If I have a car loan outstanding and I miss my payment 1 month,
Yep.
maybe they'll ding me with a late fee. If I miss my payment 2 times, 3 times, I
Look for
better
that tow
be
truck around the
careful
corner,
that
right?
I'm going to be scared every time I drive by a tow truck, right? Then so let's talk about
Yeah.
the one more feature of this IBC policy loan, which is the predictability. You want to touch on
Sure.
that? Why does the predictability piece
Yep.
of IBC loan matters?
Well, yeah. So predictability, right? I mean, we're talking about what can you depend upon to be the same. And you could certainly depend upon, your cash values being the same, actually increasing every year. So that line of credit is, set. You don't have to worry about it. Unlike, a bank loan, or even a bank line of credit, okay, and this has happened to us where that's really determined by the bank and your credit score, your FICO score, and your credit worthiness at that time. And things change, right? We had a personal line of credit, which is still better than the loan. We understand, that the bank decided unilaterally to pull because they needed to shore up their margins or whatever. We hadn't been using it a lot, and they have every right to do that. But you're subject to that, and that is not a predictable source of capital in that case, right? That would never happen with a policy and the cash values that you have access to that only increase every year. Mhm.
Yeah. And case in point, this is just a recent news that development that we want to bring up that kind of really um,
Brought it home.
mainly brought it home for us. It was, the news of Spirit, right? The Spirit airline completely just overnight
Oh,
disappearing,
yeah.
right? So, and if you really dig into what happened, they actually had they filed for bankruptcy and they actually had restructured. They agreed to long term. They were making their payments. And then
Yeah.
overnight at 3 a.m. in the morning, they decided that they can't operate anymore. Why is that, right? If you really dig into it, part of that reason was because the bank had pulled the loan due on them, and
Yeah.
they couldn't afford it. So it happens on a personal level, like it did to us, and then it also can happen to business operators. And if you own a business and you're operating a business, and cash flow is really the key to your life, and something like that were to happen, let's say you were depending on a line of credit to make payroll and whatnot,
Absolutely.
if
Yep.
that line of credit gets pulled through no fault of your own, you are stuck.
Oh yeah.
You're scrambling. So control, flexibility, predictability, those are the three key main benefits and the reasons why we just love using IBCs.
Yeah.
So let's then talk about it then, right? What happens psychologically when someone controls that financing process themselves?
Well, I kind of mentioned it, right? Psychologically, it's very liberating.
Mm.
You have a certain, calm come over you when you understand. Now, I have this pool of capital, like Nelson called it, this pool of money that not only can I own, control, and have full access to, but is ever increasing, right? Regardless of whatever I decide to
Mhm.
do with the policy proceeds, the loan. Um, that's a huge, game changer in my opinion. So it gives you peace of mind. It gives you more confidence with your capital as far as, where it came from and what it's doing while it's out there that you just don't have when you're at the, mercy of the banks. Hmm.
Yeah. And I want to circle back to something, a term you mentioned very briefly earlier on, or maybe we mentioned in previous episode, which is very relevant to policy loans, which is the term uninterrupted compounding, right?
Mm.
Because that is probably the part that people kind of debate or they're confused about the most. And I think, in my opinion, this is my personal opinion, if you don't understand uninterrupted compounding when it comes to IBC policy or the concept, it is very hard. It's a big hurdle to wrap your head around. And if you don't understand this piece, most
Yeah.
likely you're not going to appreciate this concept or this
Yeah.
way of investing. So, what does uninterrupted compounding actually mean in practical terms?
Okay, so compounding, we joke, right? It's the eighth wonder of the world in financial terms, certainly. But what it means is that your capital, your money, okay, in this vehicle is compounding, right? So the interest that is, it's growing by that rate is not just, on a fixed basis, but compounding. It adds to that principal and continues to grow on a, ever increasing rate because it is again adding to itself. And when you factor in, the consistency of that or the uninterrupted, nature of this compounding and the tax-free Nate, by the way, it's a total game changer. Um, all that's great. The big difference is with a loan, a bank loan, auto loan, whatever, there is no compounding whatsoever, right? That money
Mhm.
leaves the bank and now it's, got its cost, that interest to you. But even if the bank was still continuing to make that money on that, it's not your capital. It's not your, policy like it is with, IBC. So,
Yeah,
yeah,
reminds me of that little, I think, riddle or what we used to teach little kids. We use that penny doubled every day
yeah,
riddle
right.
or
That
a little
and
trick that we ask kids to see if they are long term thinkers or not. Right? We ask the kids, hey, would you like $1 million today? Would you take $1 million cash today, or would you prefer that I give you a penny but I double it every day? A penny doubled every day, right? So,
yeah,
that compounding, if you were just to Google the results of the penny doubled every day results after 30 days, I think you'll end up with over $5 million
yeah. It was a
because of the
lot of it was
power of
maybe 12,
compounding.
I think. I don't know, but it was certainly much more than 1 million, right?
Yeah,
Yeah.
certainly. But I think by the 15th day, by
Oh
halfway,
yeah, it
it's
was
already
way more than 1 million.
incredibly powerful.
Yep.
Powerful, and
Yep.
and if you were to extend that thinking a little bit more to the next level, if you were to interrupt the compounding, let's say I only let it double for 15 days, and then I took out the whole thing and I used something, that interruption kills the growth.
Yep.
Now my money is no longer earning. If I were to, you know,
Yep.
borrow from my account rather than against my account, I interrupt the compounding, meaning I withdrew the
Oh yeah.
money out. I got to redo it again. That compounding curve gets interrupted, and that is stop and go, stop and go. That's what the resistance happens in
Yeah.
our money cycle.
Yeah. So compounding is great. Uninterrupted compounding is better. Uninterrupted
Mm-hmm.
tax-free compounding is the best. Now, but I
That's
just want
right.
to add one last wrinkle to this is that, hey, what is it actually, what is it compounding into, right? Remember, this is a whole life policy, a life insurance policy, a death benefit that's ever increasing. And this asset isn't nothing, by the way. It's literally compared, it's what backstops and guarantees all of this excess capital and increasing leverage that you get to enjoy through the policy loans, right? Remember, this asset not only backs all this loans, but hey, let's assume worst case scenario. You got borrower A who borrowed a ton from the bank and borrower B who borrowed out of their policy, right? God calls them away early. They default or they don't pay back the loan and they die. What happens to the bank loan? It's called due. Okay. It goes through the estate, and now your family may have to pay that back. Okay, creditors are not going to be happy. They're not made whole. They're going to be mad, and that type of outstanding debt is that's a real thing to worry about. What happens on the other side? The person who borrowed from their policy or out against their policy. Well, you have the death benefit that's been growing all this time. It's always going to be significantly more than enough to make whole any amount that they borrowed, even if they borrowed it all out. If they died and they haven't paid it back or haven't paid any of it back, it's okay. Everything's wiped out. The death benefit comes in, wipes it all clean, and that significant excess beyond anything that they owed, principal plus interest, still flows to their loved ones and anyone they care about, to their beneficiaries. So huge, huge difference.
Yeah. So I know we have covered a lot, but one
Yeah.
more question that I want to ask you is there's also tend to be an obsession over interest rate. Okay.
Yes.
So
Sure.
what are people missing when they're only focused on loan interest rate? And I think a lot of that could be baggage that carries over from borrowing from, traditional or commercial
Sure.
banks. But can you unpack that for us a little bit?
Yeah. This reminds me of it's about the nature, not just the numbers, right?
Mm,
So when we talk about interest rates, you're presumably comparing, cost of interest as far as like the bank is offering this loan, maybe 3%, and then my policy is 5 or 6%. Well, the 3% must be the way to go, certainly, right? So when you're talking about interest, that's a very limiting metric that through which we're making a decision on, because people are like, duh, I'm just going to borrow from the bank if it's a lower rate, right?
mm,
And that makes sense again, but here it's way more than that. You're focusing not even on one tree and missing the forest. You're focusing on a branch or a leaf here, because like I said, it's the direction of the interest, okay, that matters. That 3% bank loan, where is it going? All 100% out of your system as profit to the bank, Wells Fargo, Chase, whoever. That 4 or 6% policy loan, where is it going? Well, it's going back to the mutual insurance company that we are owners of, that pay us dividends, have death benefit, compounding tax free. Oh, so it's where it's going that's more important even than what the nominal rate is. Okay, so yeah, I just wanted to say, yeah, we can talk about rates, but there's a whole world much bigger, as far as the impact to your, your decision on that.
yeah. Absolutely. And when we step back and look at all this, what do you think? Let's tie it back to our investor friends, our investor circle. What do you think investors are really gaining here beyond just access to capital? Because that's what a bank line of credit is. It's access credit capital. But with IBC loan, there's
Yep.
above and beyond. What is that?
Okay, great. Like I said, the line of credit is already a step, I think, an improvement above the just straight out blank loan. But really the big difference between a line of credit from the bank, whether it's a HELOC or whatnot, is going to be what it's collateralized against, right? With the bank, it's going to be against either the home, the business maybe, a more or less static, non-guaranteed, asset that is going to extend the value for which you have this line of credit that you can use, again, subject to the bank's approval and, what they determine, you're worthy for, as opposed to the policy owner who has this asset, which is the policy itself with a death benefit and ever growing cash values that are backstopping, and allowing for that ever increasing, by the way, line of leverage or credit. Okay. So the line of credit with a HELOC, it's fixed, by the way, and it's not forever. The banks control that. They tell you how much you got to make sure to pay and all this, thing. Because even the HELOCs have a minimum payment you have to do. With a policy loan, there's no minimum. You don't have to pay, this month or next month, 6 months. Okay. Every year, you just got to make sure you cover the interest. Being an honest banker, okay, have a plan for it. Great. Pay it back sooner, even better. But yeah, I would say
Yeah,
those big difference.
for sure, for sure. So at a deeper level, let's tie it back to IBC, Nelson Nash. What do you think Nelson was really trying to teach people through this
Yeah.
concept? And he even talks about, this, he discussed loan, in detail, and right off the bat tell you that it was worded incorrectly. So what do you think Nelson's book really is talking about when it's
Yeah, I mean,
referencing
the
the
first paragraph,
policy
I
loan?
think, he says this is not about, investments or investments of any kind. It's about a method of um, accumulating and pooling your capital and controlling that money so that you can use it for financing anything and, all things throughout your lifetime. And in so doing, it's way more important than any investment that you can put your money at risk for. We want to be the banker, right? We have to be, in control of our capital. And anytime that we can control that function and recapture that interest, all that interest for financing that otherwise goes out to the banks, we're in, recapturing into our own ever-growing system. We're going to be way ahead of our peers. Mm-hmm.
Yeah. Ultimately, I feel that Nelson was just trying to teach us ordinary people on how to, think differently, challenge our way of thinking, and it takes time to do so. Even
Yeah.
just on the word loan, just we
There's a
spent
lot
half an
to
hour
unpack. Yeah, yeah.
just
This
talking
is
about
just
this
one
word.
piece to this entire, puzzle that we love to play around with and, work through.
There's so much more. So,
Tune
we
in.
will,
Yes.
yeah, we will continue to talk about whatever comes up to our minds and that we wanted to discuss.
Or just tell us down below what you want to hear next. We're open. We're always listening. We're real. That's the thing. And again, if that interruption with the internet didn't prove it, yeah, this is not AI.
Yeah.
Thank you for joining, tuning in. To get in touch with me, DM me. You can add a question in the reply, or just reach out to my email or Pay's email that's also in the show notes. Reach out to us directly if you like to schedule a call, meet us. Answer your questions, get more information. I highly recommend that. And anything else you want to add? Oh, make
That's
sure,
it
of
for
course,
today.
right? Like we always reference back to Nelson's book. This is what started it all. Or, get a copy of my book, Dibs. We talk a lot about interest and borrowing and, income stacking. But again, until next time, thanks for tuning in. We'll chat more next.
Thank you. Bye.
Bye. We want